Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, we share our ultimate stock picker's favorite new money buy. We shine a light on two undervalued stocks. Russ Kinnell discusses high-profile fund manager changes. And Ed Slott tells us what should be on our radars for tax season. Let's get started. Here's what the top managers added to their portfolios.
Each quarter, we take a look at the recent transactions of some of the top money managers around today, who we call our ultimate stock pickers. Last quarter, one stock in particular was a popular new money buy among the group. What are new money buys? Stocks that managers purchased that weren't in their portfolios the prior quarter. T-Mobile topped the new money purchase list with 3 funds buying into the firm, despite not holding any positions in the company the prior quarter. After its acquisition of Sprint in 2020, T-Mobile now matches the scale of its larger rivals, AT&T and Verizon. With roughly 65 million postpaid and 21 million prepaid phone customers, T-Mobile provides service to nearly 30% of the retail wireless market. We think the company has recorded an impressive turnaround over the past several years. Despite initially lagging behind AT&T and Verizon and recording significant customer losses, T-Mobile was able to improve service, deploy new technologies, and provide better geographic coverage and capacity. These improvements resulted in significant customer growth for T-Mobile. Despite the increased scale and improved cost position, Morningstar doesn't think T-Mobile has carved out an economic moat yet, though we do assign T-Mobile a positive moat trend. We think shares are worth $108 apiece.
Expand your investing horizons and look to the long term with Morningstar's podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. Now, here is what we think of Molson Coors and Roper Technologies.
Today, we're covering 2 fundamentally sound stocks our analysts think are undervalued. We view the risk-reward proposition of Molson Coors as incredibly enticing. The momentum in the shares was tripped up by disappointing fourth-quarter earnings, where results were tainted by renewed lockdowns in key European markets. In our view, the market's single-minded focus has presented an opportunity for patient, fundamentals-oriented investors. Management has little control over outside factors like coronavirus breakouts, and we think the firm is doing a good job in the areas where it does have some control. We believe the market continues to price in worse than mediocre marketplace performance into perpetuity. The firm is certainly a lower quality play relative to other alcoholic beverage companies under our coverage. Still, there are remnants of competitive advantage that it enjoys, including meaningful scale and distribution breadth, and we believe its investments in innovation and growth-oriented partnerships will start to balance the structural headwinds in its legacy business over the long term. We think shares are worth $60. In our view, Roper Technologies is the highest quality name among the larger U.S. multi-industry firms we cover. Management has developed a laser-like focus on acquiring cash-accretive businesses purchased at reasonable valuations. This dynamic, combined with Roper's decentralized culture that cedes operational control to best-in-class, specialized managers, are why we think Roper's runway for success will continue. Finally, Roper is fortunate to own businesses that gush cash and enjoy large amounts of deferred revenue. Many niche software businesses benefit from this dynamic because customers pay cash for services far in advance of when services are rendered. These asset-light, recurring sources of revenue are protected by strong moat sources, including switching costs and network effects, that grow at mid-single digit over the long term. While Roper will have to deleverage in 2021, and the stock will likely face strong pricing headwinds amid rising interest rates, long-term investors have an opportunity to acquire an interest in a well-run, strong company. We think shares are worth $452.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Next, we have Susan Jabinski from Morningstar Inc. and Russ Kinnell from Morningstar Research Services.
Hi, I'm Susan Jabinski with Morningstar. Several high-profile fund manager changes have been announced so far this year. Here with me today to talk about 3 of them is Russ Kinnell. Russ is Morningstar's Director of Manager Research and editor of Morningstar Fund Investor. Hi, Russ. Thanks for being here today.
Hey, Susan. Good to be here.
Let's start off with talking a little bit about the number of fund manager changes we've heard about so far this year. Is this about typical for a standard year? Is it a little more, a little less?
Yeah, it's typical. You often see a number of changes after the new year starts.
And how, in general, do our fund analysts assess a fund manager change? And what impact could a fund manager change have on our fund analyst ratings of the fund?
Oh, yeah. So typically when a manager change happens, our analysts will do a full review, especially if it's the lead manager. If it's someone who's only running 5%, they might not. But people are really important to our ratings, and therefore a manager change really gets our attention, and we want to really dig in and understand how good is the new manager, what's their track record, are there any indications that there might be strategy tweaks as the new manager indicates. So a lot of things to sort through, and we'll talk to the manager, but we'll look at the new manager's records elsewhere, see how good if they have a good record elsewhere, and how relevant those records are to the current fund. So really, there's a lot to unpack.
Now, one of the most notable changes we've heard about so far this year is out of T. Rowe Price, and it's Larry Puglia, who we've nominated before for our Fund Manager of the Year award. He will be stepping down at T. Rowe Price Blue Chip Growth. Can you talk a little bit about that one and what the implications are for the fund?
That's right. Larry Puglia has done a great job over a very long stretch at Blue Chip Growth. So we're sad to see him go, but it's not a surprise. T. Rowe managers are actually very consistent. They almost all, when they retire, it's almost always between ages 60 and 64. And so actually a year ago, T. Rowe named Paul Green a co-manager. And given Puglia's age, it was pretty clear where this was headed. T. Rowe tends to do these nice long transitions. And so actually when that happened, we lowered our people rating one notch, and we lowered the overall rating from gold to silver. And then when T. Rowe announced this in January 2021, that it actually was going to happen, that Puglia was going to retire, we didn't actually change the rating because we already anticipated that. So the reason we still kept it a pretty high rating with Paul Green is a very good record at their communications and tech fund, which is obviously relevant for a large growth fund. So we liked the long transition. We liked his record elsewhere, but as a recognition, of course, you're moving up both in terms of how much AUM you're running and a wider strategy. So that led us to take it down one notch, but obviously, as the ratings imply, we still have a lot of confidence in this fund.
Now, we've had another manager change at Artisan Midcap Value, and there we did make a change recently to the fund analyst rating. Tell us a little bit about that one.
Oh, that's right. Jim Kiefer is stepping down, and that led us to lower the people rating from above average to average, and that led the fund rating to go to mostly neutrals. And the reason there is, in this case, the new managers don't have as long in the strategy as we'd like to see. So they're a bit more of an unknown. And that leads us to, we still have process rated above average because they have been maintaining that process. So we assume process will be fairly similar, but with people at average, that took the fund rating down a notch.
And lastly, Neuberger Berman International announced a fund manager change. Manager who's been there as the lead manager for 20 years is going to be stepping down. So what are the implications for that fund and its rating?
Yeah, it's really an unusual story. You don't see very often. Benjamin Siegel, as you mentioned, longtime manager. He's, I think, 51 years old, and he's actually stepping down to become a high school math teacher. He said his high school math teacher really affected him and changed his life. And he wanted to return the favor to the next generation, which I think is really great. In this case, he's handing the fund over to Elias Cohen, who's steeped in the strategy, been there for a while. But we did lower our people score one notch. And so the fund with different share classes had been rated a mix of silver and bronze. Now it's bronze and neutral because the new manager has been part of the strategy for a while, but we don't have that track record with buy-sell control to really give us enough confidence to keep the people's score. So it's an interesting story, both from an investment side and just a human side as well.
Well, Russ, thank you for your time today and for helping put some of these changes into perspective for us. And we'll probably be talking to you before the end of the year to talk about some other manager changes that are likely to be announced. Thanks for your time.
You're welcome. Sounds good.
I'm Susan Jabinski with Morningstar. Thank you for tuning in.
And lastly, Christine Benz from Morningstar Inc. and tax expert Ed Slott guide us through tax season.
Hi, I'm Christine Benz from Morningstar. We're in the thick of tax season. Joining me to discuss what should be on your radar as you ready your 2020 tax return is tax and IRA expert Ed Slott. He's author of a new book called The New Retirement Savings Bomb. Ed, thanks for being here.
Great to be back with you, Christine. Thanks.
Well, it's great to have you here. Let's talk about the 2020 tax year. It was an odd year in many ways. I want to talk about some of the dimensions of the CARES Act that might affect how people approach their taxes for 2020. One is for people with required minimum distributions. They didn't have to take them last year, but some people took them early. What sort of documentation do they have to show to make sure that they're on the up and up with the IRS?
Well, they don't have to show anything. They have to report what happened correctly. The problem now is people are getting 1099s in the mail. It's exactly as you said. They took the RMD, but then the CARES Act didn't happen till later in March and said, now you don't have to take the RMD for 2020, required minimum distribution. So then they put it back, and their advisors or their financial institutions told them, all right, it's a wash. You're all zeroed out. So now we're in 2021, they're preparing for their taxes, and they see this 1099-R, which is the form that reports all distributions from retirement accounts. I know this is a problem because the accountants are already calling me. So let's take an example. Let's say the RMD was 10,000. They took it, they put it back. In their mind, they're square. But now they get this 1099-R says they owe tax on 10,000. So now they're screaming to their accountant, to their financial advisor, to the banks, you did it all wrong. The 1099-R is correct. Unfortunately, it only reports, and IRS gets a copy, it only reports the amount out, not that you returned it, because the financial institutions, they really have no idea what you did with that money. So they're not going to go on the line and put it on a form that it was returned as a rollover. You have to do that on your tax return. So either you're doing it yourself, or you have a tax preparer, you have to show them or tell them you have your backup anyway, and you will get backup from the financial institution. You will get a Form 5498, but after tax time, and that doesn't get attached to your return anyway. So on your return, you will have to show, in that example, the 10,000 that came out, because you have to match up. Remember, this is all computer matching. There's no one to call to say, here's what I did at the IRS. Now, it's all computer matching. So you have to match up with the 10,000 as the gross distribution. Then you treat it as a rollover, as a regular rollover when you used to go from, say, one bank to another or one advisor to another, IRA to IRA, and you write in the word rollover. I got to stop saying that. Nobody writes in anything on a tax return anymore. It's all computer generated. There's a checkbox, an input box on most tax preparation programs, or your accountant knows how to do it, that checks that you did a rollover. When you check that box, it's going to print the word rollover. And if you put back the whole amount, it will print taxable amount 0. If you didn't put the whole amount back, the amount you didn't put back will show as taxable. So that's how you handle that.
If someone didn't take an RMD at all, they don't have to provide any of this documentation,
Nothing happened. Or let's say somebody did take an RMD and spent the money. They needed it. Then everything's like normal.
How about the hardship withdrawals that people who were affected by COVID were able to take from IRAs or 401ks? What type of documentation do they need to provide?
They have a similar problem, but worse. For most of the financial institutions, they're reporting, I know Fidelity, Vanguard, reported about 6 to 7% of the people took those distributions. They were only available in 2020. This was the CARES Act. Most of the benefits there ended in 2020. So we were talking about RMDs. They're back in 21. It was not it didn't continue the waiver. We're still getting those questions. The same thing with the CARES Act distributions, the coronavirus related distributions, CRDs, another acronym. And you were allowed to take in 2020, no more, if you were affected by COVID, either health-wise or loss of income-wise, up to 100,000 out. And the benefit was that if you were under 59 and a half, no 10% penalty. Also, you still had to pay tax, but you could spread the income over 3 years. And if things turned around, you could repay it to eliminate or reduce the tax bill. So now we're in 2021. The CARES Act is over, but the aftermath, the reporting is here on your tax return, similar to what we just talked about with the RMDs. Let's say another example, you took 60,000. I made it a nice, easy number to divide by 3. 60,000, and you chose the default. You want to report 20,000 each year for the next 3 years. Now you've got that 1099. Guess what it's going to show is taxable? All 60,000. So you have to, again, tell IRS on your tax return, but it's a little more difficult. You have to go to another new tax form for this year, the 8915E, as in Ed, 8915E form, to tell them how much of the income you want to report this year, because you could report it all if you want to make that election. Who would do that? Anybody that had really low income in 2020 and expects their income to increase in 21 and 22, so they don't want to have the income there. Once you elect, that election is irrevocable. So you go to this form for 2 reasons. For the income inclusion, to tell the IRS how much you're including as taxable income, and to show that the amount you're including, if you're under 59 and a half, is not subject to the 10% early distribution penalty. There's no code to tell the IRS that it's exempt from the penalty. So if you don't do this extra reporting, or your accountant, I would suggest an accountant in this case, a tax preparer, if you don't do that extra reporting, the IRS is going to think it's all taxable and subject to a 10% penalty, because the 1099-R shows it as a normal distribution. You have to give the rest of the story on your tax return.
The CARES Act also included a small charitable contribution deduction. Let's talk about that, and also talk about what aspects of that are carrying forward to 2021.
Well, anybody who doesn't itemize, which is most people don't itemize anymore because of the larger standard deduction the last few years. So if you don't itemize, you're basically not getting any tax benefit out of your charitable gifts. So they threw a bone to everybody for 2020. You could deduct $300 even if you're not itemizing, and it reduces adjusted gross income, which is a good deal. For married couples filing joint, the big question was, do I get $600? No. But for 2021, you do. They expanded it. They kept it for 21, allowed married couples to use $600, but then they said, but we're going to take something back because we just gave you too much. The deduction will not be an above the line deduction, will not reduce adjusted gross income. It will only reduce taxable income. So it's not worth as much.
So this is a cash contribution, right? I can't
cash
donate.
Contributions, exactly. Thank you for clarifying. Yes, absolutely.
Okay, Ed, it's always great to get your perspective. Thank you so much for being here.
Thanks, Christine.
Thanks for watching. I'm Christine Benz for Morningstar.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar, Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.